All right, thank you everyone. Thank you for attending. My name is Seewing from Real Estate Network, and my special guest speaker is Mr. Richard Advani from Supreme Lending. He is a investment loan agent. He does financing on all 50 states. And thank you for attending, Richard. So today what I'm going to do is I'm going to do a case study. I'm going to do a walkthrough of a investment property. Okay, for you folks out there, those investors. Now, I know there's a lot of chaos going on in the world, right? I mean, we hear of, real estate investing is very challenging, and there are inflation situation. There's a war in Ukraine, and then there are, the real estate market is, going through a lot of changes. So, as a real estate investors, I'm going to challenge you just to focus on your unique real estate portfolio acquisition. So with that in mind, Richard, I'm gonna allow you to comment on this momentarily. So, okay, let's go to the process. Okay, I'm using this a new construction single family home as a case study. Could be a duplex, could be a fourplex, but this is a new build or newer resales in a hot market in, for example, in North Carolina, in Florida, or Texas, or a few places in South and Southeast. This business model does not apply in other areas of the US. So with that said, so Richard, I'm going to put you in the shoes of a real estate investor. So after your research and due diligence, you decided to buy this property at $375,000. You and I know that right now we are going through a historic record low inventory of homes. We are still seeing demand as we speak, even though the interest rate at 5%. We're seeing skyrocketing appreciation in the past few years. We're seeing skyrocketing increases in rents, for tenants, for renters out there at 10, 20, 30, 40% rental increases in some markets in the US. And there's a shortage of homes to buy, of course, and there's a massive shortages of homes to rent. So with that in mind, let's play this through. So you close escrow on this property at $375,000. The property manager, before you close escrow, the property managers put this property in a market for rent. There are around 50 rental applications. Okay, so the property manager pre-screened this 50 rental applications, and the property managers were able to decide to rent a property to someone who's making $75,000 a year. Maybe a truck driver, or maybe this truck driver have a spouse. Maybe he's working as a nursing assistant, making $40,000, whatever. So they have $80,000, $75,000. So they have the money to pay this rent, $2,500 for whatever reason. The tenant, they are not in position to buy. They just moved from out of state somewhere, that migrated from other part of the country into this area for affordability, cost of living, good, suburban, a lot of space on a single family home rental. So they're happy about it. So easily this $2,500 or this renter is paying down the mortgage for you. So, and then you put, as an investor, you put 25% down payment. And at the end of the day, you're getting monthly net cash flow, $175. So now, as an investor, you're thinking, it's okay cash flow, not great, but this is only a initial analysis, right? So what you're thinking, I know this house is rented like 12 months lease, 1 year lease. Most likely, this renter gonna live at this house for 3 to 4 years, all right? So you as an investor lock in the 30% interest rate at 5.3%, okay? And fixed rate. And then, so all the chaotic situation as a real investors, you don't really care. As a matter of fact, the renter does not care. The renter are happy to rent your house. They have a family to take care of. The renter are not gonna, you know, the renter gonna do their job, right? Work hard for the family, provide for the family, live their day-to-day life. So they can rent your house for 3 to 4 years. And then let's 3 or 4 years later, the renters are paying down your loan. You're just putting 25% down payment. That's your initial at risk of your down payment. That's it. Everything else, the renter gonna make you rich, really, if you think about it. So because it's a new house, most likely the builder can give you a 1-year warranty, 5-year warranty, or 10-year warranty. So the maintenance cost is very, very low. So projecting forward, if the interest were, if the rental would lease after 3 or 4 years, then you may have a 30-day vacancy before the property manager will get you another renter. So what if each renter can live in your house for 3 years? So in the next 10 years, all you need to worry about is 3 renters renting your home. That's it. That's all your worries. What if the homes are, your home in a 5th year, there's a correction in that particular market? Maybe the house value have dipped just a little bit. As a real estate investor, do you even care? Right? Because you're a long-term investor anyway, you're collecting rent, you're making cash flow, you're increasing your rent to the tune of 5% every year, right? So you're increasing your cash flow, right? You're getting some appreciation of at least 5%, maybe more, right? As you can see right here, you're getting the value of a tax benefit, you're getting the value of a principal reduction, the renter, right? And then you get the value of a annual monthly cash flow and appreciation potential compounding growth of your property. So in fact, if you pursue this further, here's where I need you. So Richard, can you add your perspective on what I just said to validate what I just said? And furthermore, if you look at this 10-year projection, I want you to go over the numbers, and you and I can go over the numbers. When the investor buy a property, the first year projection is important, but you have to look at total return on a year-to-year basis. That's a lot of investors, they have not done that. They don't know how to do that. They don't know how to crunch the numbers, but we can help from a high level. So what are your thoughts, Richard?
Yeah, I mean, I think the gist of obviously what you're saying is definitely correct. Real estate is a long-term wealth building vehicle, and the longer you hold it, the more wealth you're going to build and create, not only because of appreciation, not only because the hedge against inflation, or the fact that rents will go up. I mean, there's a ton of factors, but the longer you have it, the more wealth that's going to be created. And a lot of us who are buying rentals, even if you're making a 10% return, if it's $300 a month, what is $300 a month going to do for you? Probably not a lot, right? But a decade from now, as rents go up, as you paid the balance down, or 2 decades from now, if you choose to pay it off early, then you're going to be making obviously $1,800 a month, the gross rent amount. You're going to have the tax benefits as well. So, being that I've invested in real estate for almost 15 years now, the last 6, 7, or 8 years is really where you see the investment really compound on itself, right? With principal pay down and everything else. So, real estate is a long-term wealth building vehicle. I'm not saying you can't develop a cash flow portfolio in the short term to make money, but even with those properties, the longer you hold them, the overall more wealth you're going to build. And more people today, in a market where inflation's rampant and cash flows are lower, more and more people today are looking at real estate as a wealth builder, as asset diversification, not necessarily chasing a cash flow number. So yeah, I mean, obviously, as we jump into this example here, I'm sure everyone will see, once again, the longer you hold it, the more wealth you're going to create in the long run.
Right, Richard, before you begin to go over the details of each of these categories of numbers, the assumptions I'm using is 5% rental increase per year, and then 5% appreciation potential. So with that said, again, Richard, you and I, we don't have a crystal ball, right? We can't guarantee anything, but this is just an educational presentation. I mean, no one can predict the future, but let's, we can use some assumptions, look at the long term. Let's, just decipher, because you're a loan advisor, you're a licensed loan agent, Richard. If everybody I can ask to go over this numbers, I mean, that's you can do it because you're a professional at your job as a loan advisor, you're a number cruncher. So with that in mind, so as you can see, this 10-year projection go over the income section, and then the expense, then the income analysis, then another slideshow will show you some other additional things. So quickly, what you want to talk about in terms of from a high level, some of these numbers from you?
Yeah, I mean, just the important thing to look at, obviously, if you look at the bottom on your cash on cash return, you'll see every year, obviously, that's increasing, and it's increasing for a number of factors. Part of it, of course, is rents going up, and the return on amortization, obviously, every year or every month you make a mortgage payment on a 30-year fixed, there's more and more going to principal and less going to interest. What I also like about this is it's realistic, right? It also shows the increase in property taxes, the increase in insurance year over year. And as you can see, even with those going up, your cash flow is going to go up every year between rents, between return on amortization, obviously property appreciation as well. And kind of to what I was saying earlier, it's very clear the longer you own the property, the more wealth you're going to build and the better investment it's going to be for you. But even early on, it's a good investment. But, if you make it to year 10 and beyond, that's where you really start seeing all of the positives of the investment really compound.
Yep, agree. So my recap on this spreadsheet right here, as you can see, the rental increase from year to year, we have vacancy losses, then the operating income, then minus the systematic increase of your taxes and insurance and all that, and maintenance and everything else. Maybe not maintenance, I should have did something better. But as you can see, if you get 5% rental increase every year, your net cash flow on an annual basis increases year by year. So, all right. And then of course, your appreciation at 5% only, see all the equity gain from year to year compounding, compounding of growth of your equity, the capitalization rate continue to rise. You may have start off today at a very low capital rate, not low, but attractive, reasonable at 5.3% capitalization rate. But over time, it'll increase your cash and cash return similarly, and your return on equity, and the final spreadsheet we can go over. Let's go over this as a matter of fact. So you look at the see your income going to increase systematically. Your mortgage payments are being decreased accordingly, and the renter is paying you, is making you rich. That's the bottom line. And then one thing I want to go over at the bottom, Richard, is that see, you buy the house at year one at 375. At the end of the year one, 5% appreciation is at 393. People doesn't realize the appreciation is compounding at 5% per year. You have to add on the appreciation from the previous year. Then whatever is the net amount, you multiply by 5% appreciation for the next coming year. So the compounding effect is like a 10x over time. So Richard, if you can go over the year-to-year value increase of this property, hopefully, and then minus the systematic decrease of the loan balance, as you can see, equals your net equity over from year to year. So go ahead. What are your thoughts on this analysis?
Yeah, absolutely. I mean, similar to the other one again, as we can see, once again, the longer we own the property with increase in rents, with increase in market value and decrease in your loan balance, which, the loan balance starts going down exponentially over time, right? Year over year, the longer you're in it, the longer it actually pays down. So overall, if you look at this example, you see the amount of equity from year 1 to year 10 almost triple. And that is a little aggressive, obviously. But I mean, the numbers are the numbers, right? And that is how an amortization schedule works. And once you realize that, you may be less apt to obviously sell homes and just hold them a little longer. But overall, I mean, this is a good example of a market like Cape Coral, which doesn't have the cash on cash return that we're typically used to. However, this is the new normal with a good quality asset, right? The front end cash flow is going to be lower than what a lot of us are used to. But overall, as you can see, as a wealth building instrument, there's not really much better of an investment out there.
Yep, that's right, Richard. So my takeaway is that I know investors, they have to show discipline and focus. They cannot be paralyzed and mesmerized by all the naysayers out there. If you look at any social media news and everything else, those people are just brainwashing, programming people, fear, doom and gloom, all those crash videos that people showing for clickbait reasons. So you just gotta be smart about it, right? And don't overreact. It's not easy to be a risk investor because you have to overcome all these negativities all around you. But focus on your personal economy. Buy a portfolio of properties, think long term, 5, 10, 15, 20 years, and even beyond, and then you'll be fine, right, Richard?
Absolutely.
Right.
Long term.
Yep. Thank you for everyone for attending. Hopefully this kind of analysis will help you. Thank you so much. This is Seewing Yi, and my guest speaker is Mr. Richard Advani. Have a nice day. Bye-bye.